All right, folks, part 2, chapter 17, some additional sources of differences between the two. Okay, as we mentioned, come on now, there we go. As we mentioned before, timing differences. Okay, so basically, like we mentioned, two different sets of rules. Now, just to make things a little bit more complicated, when you get up there with the big boys, then you have some entity differences, meaning what kind of entity are you talking about, and is consolidation going on? Okay, so again, makes it a little bit harder to do, but people don't do this without any practice. They've been doing it for quite some time. All right, so here, this is the 5-step process. Now we're going to go through this, but when it comes time to doing the problems, it's a bit easier with some numbers involved. You still have to pay attention, but it's a bit easier. So the first thing, notice step 1. Okay, and notice a systematic approach. Okay, so they want you to follow a system so that you get it right. Notice it says identify all permanent and temporary differences plus any carryover amounts. Then calculate the current income tax provision. Okay. Next, determine deferred tax balances. Okay, so you're going to take a look at the deferred tax asset and liability accounts. Okay, get those ending balances. Next, we're going to calculate the deferred provision. Then we're going to take a look, we're going to evaluate an allowance account. Now notice, allowance account, it has to do with realizability. In other words, do they have deferred tax assets that they're never going to be able to use? Maybe they're going out of business, something like this. And then the need for an uncertain tax benefit reserve. This is, again, related to whether or not you're going to wind up having some sort of issues with taxes. Okay? All right. Now we're going to talk about permanent differences. Now, permanent differences just arise out of a difference between the rules. Sometimes things are simply not taxable. Okay? So permanent differences, they either appear on the income statement or the tax return, but never both. Okay? But never both. And the reason why is because there's no crisscrossing going on. It's differences. Okay? Okay? So what happens is there's no deferred tax impact because they're not going to change anything in the long run. They are going to have an effective tax rate impact. Basically, what that means is that these permanent differences are going to change the rate today, but there's not going to be any future, there's not going to be any reversal or anything like that. So there's not going to be any future change. It's all happening today. So a couple of these you might recognize. So here, tax exempt interest income. Okay, so notice here it's tax exempt. So this is in your GAAP income. So this is GAAP income, but it's not taxable. Okay. So you can see that's never going to be taxed. So that's going to be a difference that is never going to reverse itself. Same thing, non-deductible fines. Okay. According to the tax code, you cannot deduct fines. They are not going to allow you to deduct breaking the law or getting fined. Okay. Meanwhile, from a business perspective, from a gas perspective, they are deductible. Now, another one is meals and entertainment expense. Those are only 50%. So on your books, you're deducting 100%, but for tax, only 50%. Okay. Now, temporary differences, again, these are the ones that reverse over time. Okay. So, over a few years or longer, depending upon how long they are, they wind up changing from one to the other. So usually these arise from revenues that are taxable after recognition, expenses that are deductible after recognition, or revenues taxable before recognition. Let me give you an example for this one especially. Rent. Okay. So you remember from your GAAP accounting, let's say your business rents out a warehouse that you have to another entity, and they pay you, I don't know, for whatever reason, they pay you 3 years worth of rent. Well, according to GAAP, you're going to recognize the current amount of money as revenue the first year, right? But the other 2 years, you're going to collect that money. You're going to have the cash, but you're going to have a deferred, you're going to have a deferred liability there. You're going to have unearned income. That's from the GAAP perspective. Now, from the tax perspective, the tax man says, Well, do you have the money? And you're like, yeah, we do, but we don't count it yet. And they're like, yeah, we don't care about that. That's GAAP rules. According to tax rules, if you got the money, you're paying tax on it. Okay? All right. And then also expenses that are deductible before recognition. These are simply timing things that happen and eventually reverse themselves. Okay. So the first thing we have to do, we have to calculate current tax expense. Okay. Notice the definition here. This is the amount of income tax due or payable for a year determined by applying the provisions of the enacted tax law to taxable income. Okay. Or excessive deductions over revenues for that year. So basically, this is the first thing you do. What is the current tax expense? So normally there's two items. There's income tax expense, and income tax payable. Okay? These two are not the same. Okay? This one is based on GAAP. This one is based on tax. And this plug right here, this is either the deferred tax asset or the deferred tax liability, depending upon how it works, depending upon what it is. Okay? So that's what brings the two together. So one, this is what it shows on your financial statements, and then this is what the government actually wants. Those, in this case, when you have deferred tax assets and deferred tax liabilities, they're going to be different. This is what it shows on your financial stuff. This is what it shows. This is what you got to pay the government. Okay? All right. So some other components of current tax expense have to do, besides the current year liability, okay, there's some other things that could potentially, depending upon what it is. IRS audit adjustments, some provision adjustments, net operating loss carryback refunds, uncertain change position changes. So there are some other items that could come in here and make it a little more squirrely. Again, that's when you've been doing this quite some time. We won't be asking anything like that. Not in this class. It's the first time. Okay. So here's an example. Okay. So it says Green Company computed its pre-tax book income at $1,000. The company had 4 book tax differences that are going to be reported on their Schedule M1. Okay. The first one, tax-exempt income. So notice this is in their book income, but it's not taxable. Okay? This is a permanent difference. Okay? Right? Here, accrued warranty. This is book, but it's not taxed. Okay? This is a temporary difference. Okay? So accrued warranty. So again, let's see the tax folks. You know how we have that you have to do an estimated warranty expense or something like this? The tax people don't care about your estimate. They want to know what you actually spent, not what you think you're going to spend. Okay? And then they had a non-deductible fine. So notice here they're deducting it in book, but not on tax. So you see how these two guys right here, negative numbers, and then tax depreciation exceeds book by 1,000. So this one is permanent too, because it's fines, and this one's temporary. So this one and this one will reverse. This one and this one will never reconcile. Okay, so let's see the current tax expense using these identified differences. Okay, all right, so we start out here with 1,000. Okay, now we're going to subtract. This is not taxable. No tax. Okay, this is not deductible. So this is being subtracted because it's not taxable. This is being added back because it's not deductible. The accrued warranty, it's being added back. This is not deductible for tax. This is not deductible for tax. Okay? Depreciation excess, we get to more depreciation because we're using straight line and they're versus tax depreciation. So we're going to subtract that. So if you got 1,000, that's 950, 1,100, 1,300 minus $100 is 1,200 bucks. That's their taxable income. So notice this is their pre-tax book income. This is their taxable income. Their tax rate is 21%, so $252.